To get us started this afternoon, we have with us Joseph Grunfest, who was sworn in as a Commissioner of the Securities and Exchange Commission in 1985. Mr. Grunfest joined the Commission from the Council of Economic Advisors, where he was counsel and senior economist for legal and regulatory affairs. On the one hand, Mr. Grunfest is a professional economist. On the other, a member of the bar. Prior to his current government service, he practiced law with Wilmer, Cutler, and Pickering, and before that was an economist at the Rand Corporation and the Brookings Institution. Mr. Grunfest is author or co-author of numerous professional journal articles and other publications. His works deal with such topics as insider trading, contests for corporate control, regulation of markets subject to kickback schemes, and many others. The topic of Mr. Grunfest's speech today is securities regulation and depository institutions. Please help me welcome the Honorable Joseph A. Grunfest.
Good afternoon. As many of you probably know, when you do public speaking, it's extraordinarily useful to have a formula joke, all right? Something that, you sort of know, nobody else knows. You take it with you wherever you go. It gets a good laugh. I'll tell you my formula joke, even though it's totally inappropriate for this organization, so I hope you forgive me. Usually I begin by saying, ladies and gentlemen, and it'll be typically a group of people from the brokerage industry or what have you. And I'll say, ladies and gentlemen, it's a pleasure to be here among so many unindicted members of the financial services industry. But you see, you do a double take on that, don't you? Under the circumstances, I will tell you my stock formula joke. I just told it to you, but I will not use it for this organization. Instead, what I will say is that usually I begin a speech with a couple of pleasantries and a joke or two or three, but not today. The situation in the S&L industry, I'm afraid, is simply too grave, and the consequences for the United States taxpayer are simply too severe to engage in much Washington chit-chat or banter. So instead, I'm going to get right down to business. And to give you a quick idea of where I'm going in this talk, I'll begin by summarizing my basic observations. First, this is a very, very sick industry, and many S&Ls cannot and should not be saved. There is, however, a group of well-capitalized institutions that can play a constructive role in the United States financial services industry if they are subject to adequate capital requirements, appropriate accounting standards, and vigilant regulatory supervision. Second, the credibility of this organization is poor, and that's a charitable assessment. For years, the U.S. League has lobbied aggressively to promote self-interest over the public interest. The chickens are now coming home to roost. To rehabilitate the credibility of this organization, you will have to start taking responsible public policy positions that show real concern for the taxpayers who provide you with the federal insurance without which you would not exist. Third, the battle for adequate capital standards backed by real money, not accounting fluff, must be won. This industry must also adopt mark-to-market accounting, accept the principles of functional regulation, and drop the shibboleth that S&Ls are vital to housing formation in the United States. The S&L industry was once vital to housing formation, but it is hardly essential today. Indeed, other financial institutions now provide the majority of mortgage lending, and the trend in the market is towards ever-decreasing reliance on S&Ls for housing finance. To survive, S&Ls must evolve, and they must evolve into a more diversified and modern industry that can take advantage of its remaining stable deposit base, its large branch network, and certain niche opportunities to provide valuable customer service. The S&L industry is not a homogeneous industry. It is an industry composed of at least 3 distinct types of institutions. At one extreme are solvent, adequately capitalized institutions. If a proper combination of regulatory supervision, sufficiently stringent net capital requirements, mark-to-market accounting, and risk-sensitive deposit insurance are implemented, then these institutions will have a viable future in the financial services industry. At the other extreme are insolvent institutions that have no real accounting capital at risk. These institutions must be shut down as quickly as possible. In the middle, we find what I call the living dead. These institutions have little or no real capital at risk because a large part of their capital exists in the form of accounting entries on a ledger sheet, entries that cannot be used to pay off depositors or for any purpose other than to procure regulatory forbearance. The future of this industry, if it has one, lies with solvent, adequately capitalized institutions that have real money on the line as net capital. The future clearly does not lie with institutions that are already underwater and whose operations continue to generate losses that saddle innocent taxpayers with tens of billions of dollars of liability. The longer these institutions are allowed to survive, the larger the liability that taxpayers will be saddled with in the future, and the larger the millstone around the necks of the truly solvent survivors in this industry. The future of this industry also does not lie with the living dead, who must rely on capital in the form of goodwill, an accounting concept that exists only as an entry on a ledger sheet and that has no corresponding real value in any marketplace on this or on any other planet. Although these institutions have lobbied aggressively for the right to apply goodwill to their net capital requirement, the reality of the matter is that even if they succeed in their efforts, they would remain insolvent in every economically rational sense of the term. History demonstrates and economic logic compels the conclusion that economically insolvent institutions will, on average and over time, generate real economic losses that have to be absorbed by federal deposit insurance. Fortunately, the House of Representatives, by a vote of 326 to 94, resoundingly rejected this industry's efforts to weaken the tough capital standards proposed in President Bush's S&L bailout plan. I have, however, been around Washington long enough and have seen enough of the U.S. League in action to understand that the House vote is not necessarily the final word on the matter. The lobbying will go on in the conference committee, and it remains quite important to emphasize the need that S&Ls backed by federal deposit insurance have real money at risk as their capital in their own institutions. If Congress allows economically insolvent institutions to remain in business without raising hard cash to satisfy minimum capital adequacy standards, Congress will be guaranteeing that significant losses will recur as a new generation of S&Ls engaged in risky investments without putting up any of their own real capital. In other words, if, for whatever reason, Congress ultimately fails to require that S&Ls have real money at risk, and if it allows the continued use of accounting goodwill as a fictional substitute for cold, hard cash, then S&L crisis will not be over for the taxpayer. It will merely be magnified, and it will be prolonged. Now, I want to concede that this argument regarding the need to eliminate goodwill from bank capital adequacy standards does not address the concern over fairness raised by certain S&Ls who claim that they would not have engaged in acquisitions of troubled S&Ls but for the promise of federal regulators to allow them to amortize goodwill over an extended period. I'm not speaking to that topic, and I would simply like to observe that the resolution of these claims is logically separate from the need to eliminate goodwill as a component of capital adequacy. It's therefore in the best interest of the strong, well-capitalized S&Ls who want to see this problem solved and not protracted to support adequate net capital standards that rely on real money, not on accounting fluff. This is particularly the case if the S&Ls are, in the future, to expand their activity beyond the banking sector and into brokerage, underwriting, and other lines of business traditionally closed to S&L institutions. Indeed, if inadequately capitalized institutions are allowed to enter new lines of business, such as brokerage or underwriting, then it's only a matter of time until the problem spreads outside the banking sector and the government eventually finds itself holding the bag for risk-taking behavior in non-banking activities. Under no circumstances can the federal government afford to let that happen. As a regulator in the securities industry, I welcome responsible entry on a level playing field by adequately capitalized savings and loans. The securities industry does not, however, deserve to be tarred with the S&L industry's brush, as will inevitably happen if inadequately capitalized institutions, the living dead, are allowed to gamble with taxpayer dollars by engaging in securities activities. Real capital at risk and true economic solvency, measured in hard cash rather than accounting fantasies, must therefore be a conditioned precedent to resolution of the S&L crisis and to entry by S&Ls into other sectors of the financial industry. Without these safeguards, government insurance will be extended beyond the banking sector, where its problems are already obvious, and into the securities industry, where its potential problems are at least as severe and where it has no rightful or logical place. Capital adequacy is not, however, the only condition precedent to S&L entry into other segments of the financial services industry. In order to be taken seriously by regulators who are not in your hip pocket, this organization will have to start talking sense rather than self-interest. The U.S. League and the entire S&L industry have a credibility problem, and it's important that you recognize it and that you recognize it candidly. The activities of the U.S. League are frequently cited as a shining example of how a talented and well-financed trade organization with a membership that's broadly dispersed across all congressional districts can influence the political process to promote its private interest at the expense of the public good. It is widely understood that partially as a consequence of the U.S. League's past lobbying success, the U.S. taxpayer will be required to pay many tens of billions of dollars to make good for this industry's excess. These payments will be in real dollars that could otherwise have been spent to reduce the deficit, to shelter the homeless, to care for the sick, or to defend the republic. The perception that the U.S. League caters to the lowest common denominator in the S&L industry is also growing. The League's efforts to weaken capital standards in President Bush's bailout bill fuel the view that this organization's priorities are set by its weakest and most dangerous institutions. In the view of many observers, myself included, the League's activities have not been designed to promote a structure that's in the best interest of the most solvent and responsible members of the industry. Warren Buffett's recent decision to withdraw his solvent, well-managed S&L from this organization illustrates the growing frustration with this bottom-of-the-barrel approach. Mr. Buffett, in his letter of resignation, described the U.S. League's lobbying efforts as, quote, so flawed, indeed disgraceful, that he was no longer willing to continue being a member of the League. Even more pointed was his observation that, quote, it is not unfair to liken the situation now facing Congress to cancer and to liken the League to a significant carcinogenic agent. And like cancer, our present troubles will recur if Congress lacks the wisdom and courage to excise elements which help cause the troubles, close quote. Sadly, the League's response to Mr. Buffett's letter was non-substantive. It rested in part on the observation that there have been more resignations from members who think that the League is not pressing hard enough to weaken the Bush plan than from those offended by the League's efforts to weaken the plan. Put another way, the League's defense to Mr. Buffett's criticism is, at least in part, to suggest that we should be grateful the situation is not even worse. The credibility of the U.S. League in estimating the depth of the S&L industry's insolvency, in proposing responsible solutions to the S&L crisis, and in measuring the policy consequences of its own recommendations, has also been seriously damaged. For example, in 1987, Congress passed legislation providing $10.8 billion to recapitalize the FSLIC, an amount substantially less than the $15 billion initially requested by the administration. The U.S. League, however, insisted that only $5 billion was necessary. The $5 billion sought by the League was a pitiful amount, measured against the industry's losses. The inadequacy of the League's plan was obvious even as it was being considered, and the estimate was so low that questions have been raised about the U.S. League's motives in recommending a $5 billion bailout bill. In particular, the suggestion has been made that the League purposefully kept its estimates low in order to allow the problem to grow to such a magnitude that a taxpayer bailout would become inevitable. That strategy, it was hoped, would allow the industry to save as much of its capital and profits as it could while passing on the greatest possible losses to the federal taxpayer. These problems have been compounded by reports of widespread fraud and abuse in the industry. For example, a recent study by the FDIC of more than 200 insolvent S&Ls grow to such a magnitude that a taxpayer bailout would become inevitable. That strategy, it was hoped, would allow the industry to save as much of its capital and profits as it could while passing on the greatest possible losses to the federal taxpayer. These problems have been compounded by reports of widespread fraud and abuse in the industry. For example, a recent study by the FDIC of more than 200 insolvent S&Ls conducted at the request of President Bush found evidence of criminal fraud and abuse at almost half of the institutions. Further exacerbating this problem is the perception that the U.S. League has mastered the art of agency capture. There are few situations in the history of the United States in which a supposedly objective regulator has been subject to influence as great as that exercised by the U.S. League over the Federal Home Loan Bank Board. Needless to say, the League's strong efforts to maintain a separate regulatory system for the thrift industry have been widely perceived as a last-ditch attempt to preserve a regulator that can be regulated by the institutions it is supposed to regulate. Similarly, the League's cozy, moneyed relationship with members of Congress has been the subject of extensive criticism and has been blamed for Congress's unwillingness to confront the S&L crisis. The perception also exists that this organization is willing to engage in revisionist history whenever that suits its purpose. The story you hear today will not necessarily be the story that you hear tomorrow. You can also be sure that despite past lobbying efforts, this organization does not easily accept responsibility for positions that may have been somewhat less than beneficial to the federal taxpayer. Thus, while Representative Gonzalez complains that everything the industry has wanted, Congress has rolled over and given to them, the industry feigns ignorance and argues that the problem was foisted on them. The public outcry against the S&L debacle and against the aggressive, self-interested lobbying conducted by this organization is growing rapidly. The New York Times, the Wall Street Journal, the Washington Post, and several other media organizations have editorialized aggressively against positions espoused by the U.S. League. Investigative journalists are tooling up massive exposés of the industry's excess. Cartoonists are beginning to warm to the acerbic potential of the industry's conduct. Radio and television talk shows are picking up on the subject, and columnists are starting to sharpen their pens as the outrage grows. This is, however, all water over the dam. A lot of expensive water over a very large dam, to be sure. We certainly should learn from our mistakes, but we must also look forward in a constructive manner to discern the future for this very troubled industry. In that vein, I'd like to lay out the bare-bones sketch of measures that are absolutely necessary if we are to restore solvency and sanity to the S&L industry. The success of these measures is also rationally related to this industry's ability to expand into other sectors of the financial services industry, out of fear that the S&Ls may lower standards in their market and cause Congress to impose tougher regulatory standards on all market participants, or hold the financial services industry liable for losses incurred by S&Ls. To put the matter bluntly, until the S&L industry is cleaned up on a forward-looking basis, S&Ls will be perceived as a class of financial lepers that are properly subject to stringent scrutiny in order to assure their solvency and integrity if and when they expand into other lines of business. No responsible industry in America wants to have happen to it what happened to the S&Ls. The financial services industry is therefore understandably skeptical of sharing a market with the savings and loan industry. Further complicating the problem is the fact that there is excess capacity in the banking industry, which includes the S&Ls. In the long run, the only institutions that will be left alive in the S&L sector will be those firms that are better capitalized and that provide real value added to borrowers and to depositors. The sooner the S&L industry recognizes that fact, the less money will be wasted in the process of cleaning up this industry. It's therefore quite important that the larger, better capitalized, and more responsible institutions in this industry begin to respond aggressively to the lobbying campaign of their weaker colleagues. Some evidence is emerging that healthy institutions will no longer carry water for their financially troubled colleagues, but much more needs to be done. If the larger, more solvent institutions are smart, they will advocate a responsible regulatory regime for the S&L industry, a regime that is not susceptible to industry capture. Only if the healthy institutions help shut down the weak will there be any long-run hope for this industry. Only if the stronger S&Ls prove their willingness to live by credible regulatory standards and hold firm against weaker S&L's efforts to degrade the regulatory process will there be any future left in being an S&L of any sort. The debate about regulation of the banking or S&L industry often proceeds as though capital requirements, firewalls, and expansion into non-banking activities are three separate topics of discussion. They are not. They're closely related in a manner that must be clearly understood if we are to allow S&Ls to expand beyond banking activities. In a nutshell, the higher a bank's real economic capital relative to the risk of its banking activities, the lower the necessary firewalls between bank and non-bank activities, and the broader the scope of activity in which the bank can reasonably be permitted to operate. If S&Ls are allowed to expand into non-banking activities without adequate capital and without appropriate firewalls, then we will be expanding the scope of potential losses to be assumed by the innocent taxpayer. We may also be creating a competitively unfair situation in which underpriced deposit insurance can be used to subsidize S&Ls in competition with non-banking financial service firms. This situation potentially adds insult to injury because non-banking firms can later be asked to pay taxes to bail out the losses incurred by their subsidized competitors. In the meantime, no one would subsidize them for any losses that they might incur. The need for adequate minimum real capital consisting of hard dollars at risk is easily explained, especially if the topic is expanded into non-banking areas. Once an institution exhausts its cold cash capital, it has no economic reason to behave as a rational, risk-averse lending institution. At that point, its only real asset is the guarantee of the federal savings deposit insurance, and the institution can invest with impunity, knowing that it can keep any gains it may be lucky enough to earn while passing on to the taxpayer all of its losses. Accounting measures of capital, such as goodwill, are useless safeguards against S&Ls willing to bet on a heads-I-win, tails-you-lose basis, because the accounting measures do not reflect the owner's real money at risk. Thus, the owner has nothing but his accounting net worth to lose, and that net worth is worth nothing except to a regulatory accountant. Goodwill is therefore not acceptable as a substitute for real dollars at risk. A simple example of the dangers that result when the federal government lets inadequately capitalized banks gamble with taxpayer dollars in the securities markets can be found in the story of Seapoint Savings and Loan. When Seapoint was founded, its owners put up $2 million in capital, which the bank proceeded to lose. With nothing left at risk, the bank decided to speculate in the futures market by contracting to sell 10,370 U.S. Treasury bond futures options contracts. These options gave Seapoint control over U.S. government bonds with a face amount of $10.37 billion. Seapoint would have made money on this gamble had interest rates declined, but instead they jumped. This heads-I-win, tails-you-lose proposition ultimately cost Seapoint $15.9 million, money that eventually had to come out of the taxpayer's pocket. Notice that a larger cushion of accounting goodwill would not have changed Seapoint's economic incentives at all. Accounting goodwill will not buy you a cup of coffee anywhere in America, and it won't pay off a single depositor. Thus, accounting goodwill is good for nothing except for providing a fictional base from which to impose risk on the U.S. taxpayer. Indeed, as one congressman recently explained, if capital standards are not properly set, Congress will be here again in a few years, spending another $100 billion. Now, even if we succeed in imposing adequate net capital standards in the S&L industry, the taxpayer will not be protected against unreasonable losses unless industry accounting practices are also changed. Solvency cannot be achieved, and it cannot be maintained as long as this industry relies on accounting practices that reflect wishful thinking more than economic reality. Much, much more needs to be done in this area. Instead of relying on historical cost accounting, the industry must move to market value accounting that measures the net worth of an institution based on the current market value of its assets and liabilities. The need to move to market value-based accounting is not yet adequately understood in this industry or by Congress. The traditional cost-based measures of accounting that underlie much of GAAP and RAP are wholly unsuited for the regulation of banking institutions whose activities are insured by the federal government. It is all too easy for an institution to be solvent on a cost accounting basis, but totally worthless on a market value basis. A simple example suffices to illustrate this point. Suppose an institution's assets are composed totally of 30-year mortgages paying 10.5%, and the institution has 6% net capital at prevailing interest rates. Interest rates then increase sharply, and the market value of these fixed-term mortgages declines by 10%. At that point, the institution is underwater and no longer has any real economic capital at risk. Put another way, no rational buyer would pay a plugged nickel for this bank, regardless of what its WRAP and GAAP balance sheets say, and regardless of what the bank's intentions are to hold the portfolio to maturity. That bank is bust, and it has all the incentive to engage in the same plunging behavior that characterizes banks with inadequate capital calculated according to traditional cost accounting measures. The federal government is therefore able to assure the solvency of its own insurance fund only if it measures the solvency of its insured institutions on a mark-to-market basis. Market-based valuations must be used for all assets, regardless of whether those assets are long-term or short-term, or whether they're held for trading or for investment purposes. Opponents of mark-to-market accounting often claim that it's infeasible because market values are hard to determine with any accuracy. This argument fails, however, for at least two distinct reasons. First, for a very large class of assets, it's relatively easy to arrive at quite reasonable estimates of market value. These valuations are easily derived regardless of whether the underlying assets are short-term or long-term, and regardless of whether the bank intends to hold those assets to maturity. Second, even in situations where estimates of market value are not easily derived, these estimates can be far more realistic than a continuous and unthinking adherence to historic costs that are clearly irrelevant. Consider, for example, the value of a real estate project acquired 3 years ago. Although it's easy to calculate the cost of that acquisition with great precision, that number is precisely meaningless because there is absolutely no reason to believe that the project can be sold for the same price at which it was bought. Regulators insuring S&Ls therefore need reasonable estimates of the current market value of an insured institution's assets, even if those estimates are imprecise. Historical values are useless unless we feel comfortable assuming that history will never change, and we know that's not true. Some small steps have already been taken in this direction. For example, the Home Loan Bank Board recently announced a statement of policy requiring thrifts to account for securities investments in accordance with GAAP. Under this policy statement, securities held by a thrift must be placed in one of three categories. First, securities being held for investment. Second, securities being held for sale. And third, securities being held for trading. Securities in the first category must be amortized over the life of the instrument, while securities in the second category must be accounted for at the lesser of cost or market. Securities in the final category, those being held for trading, must be marked to market. While these measures are to be applauded, they hardly go far enough because they still leave a major portion of an S&L's balance sheet, namely those assets that the S&L intends to hold to maturity, free to reflect unrealistic valuations based on historical costs that may no longer reflect true market realities or the federal insurance fund's exposure. To survive and to compete in the financial services industry of the future, the S&L industry must come to grips with the concept of functional regulation. Like President Bush, I believe that functional regulation is the most appropriate strategy for addressing the issues raised by expansion into non-banking activity. Functional regulation means that S&Ls entering into brokerage or underwriting businesses, for example, would be regulated by the same agencies that regulate brokers, underwriters, and other securities market participants. Functional regulation thus establishes a level playing field among all participants in a particular market. Differential regulation, on the other hand, inherently gives one set of market participants an advantage over others, and thus prevents the market from doing what it's supposed to do, rewarding efficient participants and penalizing inefficient ones. What does the drive towards functional regulation mean for the S&L industry? Basically, S&L should not expect to be allowed to engage in the securities business or in the insurance underwriting business unless they are willing to be treated like any other securities firm or insurance underwriter. If S&Ls and other banking organizations truly desire to engage in securities brokerage in competition with broker-dealers, for example, they should, I believe, be prepared to surrender their exemption from registration under the federal securities laws and to accept SEC regulation just like every other broker-dealer. Furthermore, even if the regulatory playing field is leveled, S&Ls will have a potential competitive advantage over non-S&L competitors because of their access to federal deposit insurance. Put simply, S&Ls can borrow money in the form of deposits more cheaply than can non-banking organizations because a loan to an S&L carries with it the best guarantee available, that of the United States government. If S&Ls use lower cost of capital to subsidize competition with non-banking firms, then deposit insurance can be used to the detriment of non-insured institutions and for purposes for which it was never intended. If there is truly to be a level playing field between depository and non-depository institutions, then it's crucial that S&Ls, as well as other banking organizations, not transfer this lower cost of capital to their non-depository lines of business. The S&L industry must also recognize that functional regulation means that S&Ls will have to adjust to unfamiliar regulatory schemes based on different statutory objectives and priorities. For example, under the National Housing Act, the Home Loan Bank Board and FSLIC are charged, first and foremost, with safeguarding the integrity of FSLIC's deposit insurance fund. Under the federal securities laws, however, the protection of investors, not the protection of banks or the protection of the insurance funds, is the paramount objective. It makes no more sense for S&Ls to ask that the Home Loan Bank Board regulate their securities activities to protect the interests of investors than it would for the SEC to regulate their deposit-taking activities to protect the integrity of the FSLIC insurance fund. Unfortunately, this industry appears to be opposed to the notion of a level playing field if leveling the field requires that the industry might have to operate under more stringent standards. In contrast, if a level field makes life easier for S&Ls, then the League is all for it. This industry cannot have its cake and eat it too. A level playing field cannot be tilted towards the S&Ls whenever it suits S&L interests, and yet be kept level in all other instances. Finally, and perhaps most important, the time has come to question the role and the purpose of the savings and loan sector. This industry has for decades wrapped itself in the flag and claimed that it's essential to housing formation in the United States. That argument may once have been true, but it is no longer accurate today. S&Ls in 1986 originated only 30% of home mortgages, down from 43% in 1979, and there's every reason to believe that this percentage will continue to decline. The advent of a liquid secondary market for mortgage-backed obligations renders inefficient the traditional buy and hold approach to mortgage lending, in which an institution holds in its portfolio the loans that it makes in its local community. S&Ls as a group do not have a comparative advantage in bearing or in judging either the interest rate or the credit risk associated with holding diversified pools of mortgages. S&Ls also have no comparative advantage in structuring appropriately diversified pools of mortgage obligations. It's far easier and cheaper to acquire a diversified pool of mortgaged assets by purchasing a portfolio of mortgage-backed securities than it is to build that portfolio from scratch by attempting to make a diversified series of home loans. Moreover, because of questions about the pricing of the option component of traditional fixed-term mortgages, that is, the option that the borrower has to pay off the mortgage if interest rates decline and to then refinance at a lower rate, serious reservations exist about the long-term profitability of even home mortgage financing as currently practiced by many S&Ls. S&Ls may have a comparative advantage in acting as originators of and servicing agents for mortgage loans that can be repackaged and sold into the secondary market. This market niche may well constitute a reasonable profit opportunity for appropriately situated institutions. But here, too, the S&L sector is guaranteed to face increased competition from banks, mortgage bankers, and other intermediaries. Indeed, some of these institutions may be able to perform the S&L's traditional origination and servicing function better than the S&Ls themselves. The future of the S&L industry is thus far from clear. If the S&Ls are to remain viable and financially responsible insured institutions, it seems clear that their activities will have to expand far beyond their traditional housing finance function. Strict prohibitions on participation in certain lines of business, such as the House's proposed prohibition on junk bond investments, are thus likely to be counterproductive. A set of capital requirements, accounting standards, and supervisory practices designed to guarantee that S&L participation in these new lines of business is conducted responsibly and without inordinate risk to the federal taxpayer is a far more sensible approach. In conclusion, S&Ls do have a future, but it's a future that's far different from the industry's past. S&Ls must, as a group, decide whether they want to evolve into a modern, responsible participant in the financial services industry, or whether they want to cling to past practices and traditions that doom the industry to becoming a ward of the state. To a large extent, I'm afraid you hold your own future in your own hands. By your own actions, you will determine whether your future is real or whether you'll be remembered as the largest corporate welfare case in America's history. Thank you very much. I'd be glad to answer any questions, respond to any comments. So you have a question in back?
A comment and a question. First of all, I'd like to say I found this to be one of the most offensive presentations I've ever sat through. And it took some urging to sit through the entire presentation. But your premise is wrong. So much of your presentation is built on the desire of this industry to move into brokerage and underwriting. I've been around this business for 30 years. You're talking to savings and loan people, not commercial bankers. We're not fighting to get into that business. And your notion that we are moving towards a shrinking percentage of the housing market, I don't know where you got your numbers. Your numbers are wrong.
Well,
We're doing over 50%, and it's not shrinking. As a matter of fact, the mortgage bankers are the ones that have been going through trouble in the last 2 to 3 years, and their market share has shrunk. So please, don't be so pompous. Don't be so sure about the direction. You started with a premise, you build on it, but your facts are wrong. Simple.
well, Well, fortunately, I'm not surprised. I expected that kind of a reaction. I'm not disappointed.
Making a presentation like
I'm not disappointed. I understand that the presentation could well be perceived as offensive by many people in the industry. By the same token, I think it's rather clear that many people are rather unhappy with some of the past activities of the industry as a group and of individual S&Ls. And I can tell you as an individual, I am not happy that I am going to have to be paying a significant amount of taxes in the future for problems that I did not create, for activities that generated no benefits for me, and I understand that many S&Ls in the industry feel exactly the same way. Now, with regard to the observation that many S&Ls are not interested in getting into the brokerage industry or what have you, I think that's exactly right, and I take no dispute with that observation. I do, however, want to observe that some are interested in expanding into these areas, and I was asked to address that question. And very simply, I think there's a great deal of concern about allowing institutions that are subject to federal deposit insurance into the securities industry under situations where they're going to be competing with organizations that do not have federal insurance and where the playing field may not be level. Third, with regard to the question of whether my numbers are wrong, there is a fully footnoted text of this speech. I understand that people will question the basis upon which I made many of my statements. Therefore, I thought that it was extraordinarily important for me to let you know where I get the numbers from, where I get the observations from, and what facts I'm relying on in making these observations. We obviously do not have enough copies, and if anybody would like a full copy of the text with the footnotes, with full citations to all of the sources, I'm glad to provide that to you. You can then argue with the government figures and the academics and the others upon who I rely. I made nothing up. I relied on other people, I relied on government numbers, and I relied on well-researched numbers. Yes?
In your view, why do you think it would be counterproductive to have S&Ls prohibited from investing in junk bonds?
Well, I think as a practical matter, there's relatively little difference between a commercial loan that's often made at a high interest rate and a junk bond. The two are real substitutes. The only question there is whether one is packaged and sold in the public marketplace or not. And in fact, one can make an argument that purchase of a junk bond, which is sold into the public market and priced by the public market, is on average, not in every case, on average, likely to be a better bargain than a commercial loan at the equivalent interest rate. The reason for that is as follows. In a typical banking situation where you make a commercial loan, what happens is you get the loan priced by a relatively small group of people. You get a credit committee at the bank. They look at the borrower and they say, you know, this borrower looks like a 16% borrower or a 15% borrower or what have you. And there you have the opinion of 4 people who may be fairly knowledgeable. But I would suggest that a situation where the market, with hundreds of analysts, looks at a company and says, this looks like a 15% borrower or a 16% borrower, is on average, not in every case, is on average more likely to be accurate, and therefore you're more likely to get an accurate balance of risk and return by that type of investing than by a small group of individuals trying to estimate the risk associated with a particular lending position. I have 2 question cards. Are there any other questions? Yes.
One of your premises is that the industry needs to venture into other areas other than home mortgages if it's going to survive. That's certainly not anything new. Back in 1982 with Garn St. Germain, that was a change that directed the industry to change. It was coupled with the 1982 Tax Act, which made commercial real estate investment very attractive. In 1986, the rug was pulled out from under the commercial real estate market. Obviously, the S&L industry that had been encouraged to lend in that had the rug pulled out from it also. Do you have any suggestions for new directions?
Yes, I think the first thing that we have to do is we have to say that the government made some very large mistakes in this area, and I think those mistakes are obvious. I think that it's perfectly reasonable to allow organizations to diversify, but at the same time that you allow organizations to diversify, if they're going to be backed with federal deposit insurance, they have to be subject to appropriate safeguards that protect the insurance industry. In particular, banks should not have been allowed to continue to operate in situations where they had no real net worth. The situation grew to be fairly serious because you had institutions that were underwater and proceeded to plunge again. I think the macroeconomic factors that hit this industry would have caused losses to the FSLIC in any event. I think the mismanaged regulation in this industry compounded those losses to a very, very large degree. I think had the situation been run well, there's a very good chance that there would not have been any need for a bailout, even in light of interest rate volatility, in light of the decline in the price of oil, for which this industry can't be held responsible, and in light of the decline in the value of real estate, again, for which this industry can't totally be held responsible. So on balance, I think the question of diversification and responsible regulation has to be addressed in tandem. If you confine this industry to the home lending market, it really doesn't have much of a viable future. If you allow it to expand without responsible regulation, then the federal taxpayer really doesn't have much of a viable future. A balance has to be struck between those two. Sure. Okay. One question here is if you want to diversify, if you want us to diversify into other financial services, which I agree, why is Congress raising the QTL? Why are we not allowed to enter into commercial banking? The QTL is a very funny number. I'm not sure that it's a smart idea to raise the QTL. There's a recent paper that's come out of First Boston which analyzes some of the consequences of raising the QTL, and they suggest that maybe that's not such a wise idea. I think what's happening here is partly a political mechanic, a political dynamic, where this industry has for years said, look, the reason why we have to be treated special is because we provide financing for the housing industry. And now Congress is saying, well, if that's the reason why you exist, what we're going to do is we're going to make sure that you don't stray too far from the home base that you're supposed to serve. And on that basis, I'm afraid that one of the lobbying arguments that this organization has used for many years is now being used against it. And I didn't agree much with the argument when you guys used it in your favor, and I don't agree much with the argument when it's being used against you now. I'll give you a level playing field on that. But I think you do have to understand the dynamics that lead to this situation. Do you want the other two questions, or? Second question is, you've called for the mark-to-market of S&Ls. Does this belief extend to banks, including LDC debt? Yes, absolutely. I believe that especially when you get into an environment where federal deposit insurance is at risk, at a minimum, for regulatory purposes, the insurer has to know whether he's insuring organizations that are underwater or not. The risk that the insurance company has is a real risk of having to pay out cold, hard cash to depositors. And I don't see any difference in whether the LDC is called Argentina or whether it's called Texas. The situation that you're in is if you're the insurer in this kind of an institution, you do have to have a very good idea of what the value of the bank is, and that requires mark-to-market. The last question is, please explain why the stockholders of S&Ls, which have goodwill as one of their assets, do not have real money at risk. Oh, they do. It's not goodwill, is not goodwill an asset that arose when an S&L with real capital put up its stockholders in cash, subsequently purchased another institution, usually a FISLIC case. Yeah, the stockholders that paid money for their stock certainly do have their own capital at risk, but the problem is there's no real money at risk from the perspective of the insurance company, from the perspective of the insurance fund. And that's the perspective that I think is very important to keep in mind here. In other words, if you were to shut that institution down today, and if the depositors showed up and they said, we want our money back, the taxpayer would have to take folding green stuff out of his pocket to pay off the depositors. He would not be able to say, look, on our balance sheet here, we've got a couple of $2 billion of goodwill. Why don't we divvy it up among you guys, and you can all amortize it over 25 years, and then we'll call it even. That won't work in that kind of a context. Therefore, another question that can be asked is, what do I think about goodwill in general and GAAP? I'm not big on that either. And we could go into another discussion, and I could explain to you why I don't think GAAP is 100% perfect, and a great deal needs to be done in order to improve the information going to investors in that regard. But I think as a practical matter, if you're going to look at the problem from the perspective of the insurer, you have to understand that, like any insurer, you need some degree of co-insurance, you need some degree of deductible. And the deductible in the FISLIC situation is the capital, and the co-insurance, which we're not really moving towards at this point, is some sort of risk-sensitive pricing. That's the kind of insurance you buy when you buy health insurance, and that's the kind of insurance you're going to have to pay for when you get health insurance for your bank through the federal government.